I'm very happy to see a number of old friends here. For those of you who don't know me, my name is Sheila Brown, and I'm the Executive Director of the Canadian Centre for Ethics in Public Affairs, CCEPA for short. And CCEPA is a joint venture of St Mary's University and the Atlantic School of Theology. Our mandate is to provide an arena for public discussion, critical thinking, and research on the kinds of ethical challenges that we face as a society, and in fact that all societies are confronted with. And with that end in mind, tonight we are presenting a CCEPA just-in-time session on ethics in financial markets. This is a moderated panel discussion on transparency, leadership, and accountability in those markets. To help us think and better understand those issues, we've assembled a blue-chip, thoughtful, and well-informed panel. And I want to take a moment before we get to introducing our moderator in the panel to thank my predecessor, CCEPA's former executive director, Frank Schwartz, who just happens to have walked in. Good evening, Frank. For all the work he did in assembling this panel. I'm the one standing up here, but it's Frank who did the work. That strikes me as a good model. Our discussion this evening will be deftly moderated by Bill Black, Chair of the Board at CCEPA and former President and CEO of Maritime Life. Bill was regarded as an exemplary CEO, and under his leadership, Maritime Life gained a very solid reputation for employee relations and was listed virtually every year among the leaders in the Report on Business list of top 50 employers in Canada. Bill sits on a number of boards, but he also leads an executive seminar for CEOs, presidents of organizations, and senior executives several times a year. And having spoken to a number of people who've attended that seminar, I know just how important it is for business leaders like Bill to convey the lessons they have learned to another generation of leaders, and Bill does that tremendously successfully. Before I turn things over to Bill, who will in turn introduce our panelists, I'd like to draw your attention to the fact that there are evaluation sheets in front of you. We take seriously our responsibility to you, our audience, our participants, and we like to hear your feedback, and I will remind you of that before the evening is over. But I do want to assure you that your feedback is extremely important to us as we plan for future programs. So with no further words from me, I'll ask you to join me in welcoming to the podium our moderator, Bill Black.
You can hear me okay up there in the back? Perfect. Good evening and welcome. I want to especially welcome Sheila. This is her first official event as our executive director, having taken over from Frank, who gave us 3.5 wonderful years. And Frank, I'll repeat the thanks I've said several times to you for really creating CCEPA and making it what it is today. Thank you all for being here. It's not an exaggeration to say that the world's financial system is a mess. Many of the world's largest financial institutions are surviving only because they're being propped up with taxpayer money. Iceland is broke. Hungary and Pakistan are only on their feet because the IMF are propping them up. Institutional and individual investors have had their worst year since the 30s, the worst year in 70 years in 2008 they had as investors. Very difficult. And that applies to individual accounts, RSP accounts, pension funds, endowment funds, you name it, they've all suffered to some degree or another. Most of us are feeling a lot poorer and confidence is low. So with this context, our speakers, our brave speakers, have been asked to reflect and share their views on several issues. First of all, who are the key players? What questions should we be asking them? And what are their roles, and are they really fulfilling them? To be a good panel, they have to be focused but maintain a high-level perspective. They have to be thoughtful but not too formal. They have to be balanced but not too much harmony. We like to have a little dissension when we run these panels. So I want to introduce to you who we have, and I am very grateful to all three of them for agreeing. These are all busy folks. Right here, Greg Grice. Greg Grice is the regional president, Atlantic Provinces for RBC Financial Group, and as such, he's responsible for the sales and market management at RBC, which includes setting direction, developing strategy, managing performance, and delivering the products and services the bank offers. Greg's also very involved in the community. He's involved with Halifax Partnership. He's on the board of trustees of the QE2 Foundation and on the board at Mount St. Vincent University. Next to Greg is Dr. Greg MacKinnon, who is a PhD in finance and is on the faculty of St. Mary's since 1996, where he holds the Pengrowth Nova Scotia professorship. Greg has published numerous research papers in academic journals on various capital markets topics, including, and holds a CFA designation. That's Chartered Financial Analyst for those of you who aren't part of that. And he serves on the local board for the CFA Society. And finally, to Greg's right is David Swanson. David's been in the investment industry as an advisor for 25 years on both the sell side and the buy side, working mostly for individual clients. He's the former director of the Investment Dealers Association in Toronto and a fellow of the Canadian Securities Institute. He's worked in Canada, Britain, and the U.S., and has chosen his Halifax as his home for the last 7 years. Now, it needs to be said that while our panelists' toil is noted in these esteemed establishments, they're not here to represent the Royal Bank or St. Mary's University or anybody else. They're here as knowledgeable folks in their overall industries. Secondly, this is a very interesting topic, and as you know, CCEPA's focus is on ethical issues. That doesn't mean that's the only thing that we'll talk about tonight, but you'll see us continually trying to maintain a slant on that. You'll get at other parts of the issues, through other sources, but if you'll see me kind of pushing the topic in that direction, that's because that's what we're about. And there is a risk that this becomes a seminar in finance and economics, but as I say, I'll try to minimize that. I know we won't and we shouldn't try to prevent it altogether. Finally, a little bit about format. Each of the panelists is going to talk for a few minutes at the beginning to try and open up your kind of mental pores and get you thinking about some of the issues and questions. When that's done, I'll lead them in discussion for a bit. They don't actually know how I'm going to do that, and for that matter, I don't know yet either because I don't know exactly what they're going to say, but I'll make a few notes as they go along and try to stimulate them. And after I've done that for a bit, and hopefully you're fully warmed up, then you get in on the process, and you should end up with roughly 45 minutes where you get to direct the questions that you want to see us getting at. When it comes time for that, and I'll probably repeat this later, it's about questions, not making speeches. So we'll ask you to try to be fairly brief and focused when you do that. So that's it for my introduction, and I will now turn it over to Greg, who will go first and just pass right on to the other two.
Very good. Thank you, Bill, and good evening, everyone. So aside from President Obama's inauguration last night, one of the most frequently discussed subjects these days clearly has to be the global economic crisis. So from media to dinner tables to boardrooms, it's a concern to families, businesses, and governments all around the world. And in running RBC's Atlantic Canadian operations here, I tend to receive quite a bit of questions from employees, from clients, and from shareholders on the issues of the day. And I thought tonight what I would try to do is summarize what I think are the three most common types of questions that I have that I've been getting, because I suspect that they're probably on your minds as well. So the issues that we face today have been widely viewed to have originated in the United States. So the first question that I typically get is, why didn't this start in Canada, and why the U.S.? And second, if it did start in the U.S., why didn't it remain there? Why did it spread globally, and what were some of the factors behind that? And the third question is a very fundamental one. Given U.S. financial institutions were a major player in this crisis, are banks really living up to their obligations to customers, to society as a whole? And if not, why? So let's start with the first question. Why did this happen in the U.S. and not in Canada? Well, as I think about that, I really think there's 4 key points that I think it's important to talk about. First of all would be the legal framework for mortgage lending in the United States. You may not be aware that in the United States, loans or mortgages are made on a non-recourse basis, which essentially means that a borrower takes out money to buy a house, and in the event that they default on that loan, the only remedy against that borrower is the house. There's no further remedy against the individual's assets or their income or any other assets that they may have. And this is, in my view, one of the main reasons why subprime lending has taken hold in an environment where there was relatively low interest rate, low taxes, huge stimulus, is that these individuals who were on the margin, so to speak, went into the mortgage lending or got into their home knowing that at the worst case they could have a bruised credit rating and perhaps would lose their house. In Canada, it's actually the opposite. We do have recourse mortgages, so the stakes are higher. So people have a second sober thought before they get into a situation where there's quite serious complications or implications in the event that they're not able to pay. The second difference relates to government policy. Now think of the American dream. A house, a yard, a white picket fence, all reinforced in the U.S. culture, whether you see it on their television programs, whether you see it in their movies, or even promoted by the government. In fact, in 1995, the U.S. government started giving incentives to Freddie Mac and Fannie Mae to purchase subprime mortgages so that low-income Americans could enjoy the American dream. And it worked. Home ownership in the United States soared to 69% in 2004, up from 64% in 1994, which was a percentage that held for 30 years. So in a short period of time, home ownership expanded quite significantly. There were no similar policies in Canada from the government to encourage that kind of home ownership. Third, the U.S. uses what is referred to as an originate to distribute mortgage model, their primary mortgage model, which essentially means that loans are typically originated through a mortgage company or a broker. They're funded through a warehouse line of credit, and then they're ultimately syndicated through a mortgage-backed security or what is known as a collateralized debt obligation, and then ultimately sold to investors. Over time, more emphasis was put on the security backing these securities, or the collateral security, versus the underlying credit quality of each individual mortgage application. And so over time, it became more about the security than it became about the credit quality. In Canada, our dominant model is originate to hold. Now, what that means is that loans are primarily originated through a branch network or through a proprietary sales force. And then most importantly, when the loans are made, for the most part, they're left on the bank's balance sheet. So the fundamental difference here is that there's a huge emphasis on credit quality to make sure that we don't get into the same kind of difficulties. And the fourth difference lies in the underwriting standards of each model. In the U.S., we ultimately saw the emergence of high-risk mortgage products, lax lending standards, and in some cases, lender abuses. And some of the, innovative products that came out in the U.S., you may have heard of them. One was called an adjustable rate mortgage, where an individual was given a teaser rate, and then after a predetermined period of time, the rates would go up to a market level, in many cases to a point at which they could no longer afford the mortgage. Or you may have heard of a ninja loan, which is no income, no job, and no assets loan, which is, just by its very nature kind of gets you scratching your head saying, how could that be possible? But in some cases, that happened. And there's actually some folks here in Halifax that have gone and purchased a property in the U.S. recently, and when they were financing that property, they said, would you like that to be a documented loan or a non-documented loan? And the difference is that if you're willing to document it with your assets and confirm your liabilities, that you would get a better rate than if you did not want to document it. So again, some fairly significant high-risk lending policies. Canada, by contrast, has very stringent lending standards. We have for generations focused on three things: the 3 C's of credit, your capacity to pay, your character of the borrower, and the collateral backing the deal. And in Canada, any situation where you're lending beyond 80% of the mortgage or the value of the home, it must be insured through CMHC or Genworth. So while Canada and the U.S. both had relatively strong economic stimulus in their markets, we as a country, I think, responded with a more prudent approach. Now, as I noted earlier, the subprime issue originated in the U.S., which brings us to that second question. How did it turn into a global crisis? Well, if we step back a few years or so, here's what things look like. We had low interest rates in the U.S. We had low taxes. We had an incredible amount of liquidity in the market, a lot of foreign capital in the U.S., all of that contributing to easy credit conditions. So everyone from the individual borrower to the global financial institutions bought into a never-ending wave of economic boom. Increasing lax lending standards allowed more and more Americans to get into home ownership, as I said. Because so many borrowers got into the subprime mortgages, the demand was met with an increased supply of funding through mortgage-backed securities and collateralized debt obligations. Financial institutions around the world, looking to enhance their returns because interest rates were so low, started to purchase collateralized debt obligations in their own portfolios. All of them relied on the investment grade ratings that they got from the credit agencies that said we could get maybe 200 to 250 basis point premium, all the while taking on an investment grade risk in those securities. And we know that that turned out to be a false assumption. So it all acted as a contagion. Soon financial institutions across the globe had exposure to the U.S. subprime problem. So things looked so good for everyone that it was hard to believe that the party was ever going to end. And it was this kind of herd mentality, in my view, which moved it from we call it an isolated U.S. issue to a much more global issue with global implications. So a lot of what happened involved banks and lenders, which begs our final question. Are banks living up to their obligations, as I said at the start? Well, we can't paint everyone with the same brush or every country with the same brush, but there's clearly some evidence that the U.S. system did not always act in the client's best interest. Today, an estimated 12 million homeowners in the U.S. have negative equity in their homes. Mortgage defaults are staggering. As of just a few months ago, the default rate, or the delinquency rate in the U.S. was 2.2%. In Canada, it's 0.28%. And as of February, 278 civil lawsuits had been filed in the U.S. courts, with many alleging fraudulent, discriminatory, or predatory lending practices. In Canada, it is a quite different story, one where I believe, as an industry, we are living up to our obligations, and I'll tell you why. We adhere to a notion in Canada of what's good for the customer is good for the bank and vice versa. Our objective is to retain customers over their life cycle. Our philosophy is a relationship philosophy whereby we can nurture relationships over a life cycle and then get the business of their kids, etc. In the U.S., by contrast, it's quite likely that your mortgage would be sold 3 times before you made your first payment. So that's the difference. Society also expects us to walk the talk and not only be good expert financial advisors, give you the kind of advice that's important for your own individual situation, but they also expect us as an industry to provide a greater good in society, and I think we do, and I'll just give you a couple final stats before I close. We stimulate the economy by lending and providing capital to 1.2 million small and medium-sized businesses. We employ over 270,000 people, contributing $20.3 billion in salaries and benefits. We make up about 3.3% as an industry in Canada's GDP, or roughly $40 billion annually. And we pay about $9 billion in taxes to all 3 levels of government in Canada. And probably last but certainly not least, as a corporate citizen, Canadian banking institution provides lots of great support to charities throughout Canada. In 2007, the industry contributed $145 million. So in closing, sometimes, in my view, the best lessons are the hardest lessons. And I think that you'll see as we evolve dramatic changes in the regulatory environment in financial institutions, particularly in the United States. But for Canada, the last few years have been validation for me that we're doing things reasonably well. Yes, we've had some bruises along the way, but I think we should all feel reasonably proud that our regulatory system and our banking system has shown Canada in a fairly good light. Bob Kelly, you may have heard of Bob Kelly. He's a native Nova Scotian who now heads up New York Mellon Bank. He recently told BNN on an interview that he thinks it would be a pretty good idea if the U.S. banking system evolved a little closer to the Canadian model. And I think in the U.S. and many European countries, as they start to think about how they're going to rebuild themselves, I would encourage them to step back and take a look at Canada. And I'd encourage everyone in this room to take a look at Canada and say that we should actually think there's a bit of pride here. We have a relatively strong government. I'm not commenting on a political party. I'm commenting on the system. We have a relatively strong system here. Canadian banks, as a rule, have performed extremely well during this crisis. And I think that's good for our clients or for you, for our communities, and for shareholders that depend on the banks for their retirement. And I think as an industry, we'll continue to work with the federal government to make sure that we have the kind of liquidity here in Canada that will help us prosper over the long term. And I think the best thing for us is to be very proud of the fact that we were voted as a country the safest and soundest by the World Economic Forum just a few months ago. So I think at the end of the day, Canada's doing a pretty good job. So Greg, I'll turn it over to you.
Thanks. Well, first of all, I just want to thank CCEPA for inviting me, and thanks to all of you for coming out here to listen to us talk. Just with my few minutes of opening comments here, I just want to key in on two of the players that I see as important in this economic crisis, to use Greg's word, or mess, to use Bill's word. And the two players I want to key in on are two that I think sort of feed off each other to a great degree, and that's the media and the government. And let me start off with the media here. Now, the media, I think their role in all this is a difficult one. If you're in the media, you got a hard job. And the reason you got a hard job is because the media is always pulled in two directions. On the one hand, in terms of responsibility, if you're going to present yourself as a news organization, you have a responsibility to present stories to the public that are obviously factual, first of all, but also unbiased. In an economic sense, I mean, not overly rosy, not overly pessimistic, just sort of factual. But also stories that contain, cogent analysis of all the relevant details of what's an extremely complicated topic, looking at different viewpoints, looking at the pros and cons of different viewpoints, et cetera, et cetera. The problem is, if you're in the media and you present a story that covers all the different viewpoints of a very, very complicated story, what you have is a long, boring story that nobody wants to read. Okay? And that's why media tends to get pulled in another direction. Because most media outlets in Canada, with the exception of CBC, I suppose, are for-profit enterprises. So their end goal has to be, to get people to read the newspaper article or watch the newscast or click on the website or whatever the case may be. And to do that, sometimes you need the flashy headline, the catchy buzzwords in the story. You need a little bit of drama in there, maybe a fairly simple plot. And as part of a good drama, you got to have some good guys and some bad guys. So you have something kind of flashy to catch the eyeballs. And for the most part, this push and pull between the flashy headlines and the very intricate analysis, for the most part, I think the Canadian media has actually done a fairly good job of providing insightful articles that provide a lot of value that people will actually read. But I think there's a couple of places where maybe they've erred on the flashy side a little bit. And maybe we can get some of the other ones later, but I'll just give you for one example. And the example is this. If I see one more story with the words Great Depression in it, I'm going to flip out. Okay? Because, don't get me wrong, I don't think the media should be a bunch of Pollyannas with some kind of, Panglossian viewpoint in the world where everything's going to be okay, because everything's not okay. It's, things are bad. Things are probably going to get worse. I think things may actually get worse than some people think they're going to get. But it ain't the Great Depression. It's not the Great Depression. It's not going to be the Great Depression. It's not in the ballpark of the Great Depression. It's not even down the street from the ballpark of the Great Depression. Okay? It's a totally different kind of thing right now. But obviously that gets people's attention. It's the next Great Depression. It's the biggest crisis since the Great Depression, et cetera, et cetera, et cetera. And I think, people in the media have to be careful because in economics and in the financial system, in large part, perceptions create their own reality. And if you ramp up the rhetoric too much, that's doing a disservice to the people you're trying to serve, which is the public. That also feeds into the government aspect of everything, because if the media is talking about Great Depression, I've noticed a lot of politicians mentioning the words Great Depression in speeches recently. If the media is ramping up the rhetoric, then the first question that everybody asks the government is, well, what are you going to do? Great Depression coming. What are you going to do? What are you going to do? What are you going to do? And what happens then is politicians, as being the somewhat short-term animal that they are, they're usually looking to the next election, they kind of trip over themselves to come up with who's going to come up with the biggest solution, the quickest to get us all out of this mess. And that could lead, and again, maybe we'll get into this later, that could lead to policy solutions that might not be optimal in the long run. Okay? But rather than looking at, fiscal stimulus and that kind of stuff right now, I just want to look at governments in terms of their other role, which is the regulatory role. And if you look at, to me anyways, if you look at the crisis we're going through now, crisis / recession / mess, whatever you want to call it, pick your label. In large part, I think you can view this as a regulatory failure. Okay? It's a failure of regulation. And since that's the role of the government, or one of the big roles of the government, it's in a sense a failure of government. Now, not so much in Canada, because, Greg's right. Canada is, relatively speaking, come out looking pretty good in all this. But certainly, we're not blame-free. There's been a lot of problems in the U.S., and Canada has done better, but there certainly has to be more international coordination in terms of regulations. We're going to have to be involved with that. Okay? Now, the thing I want to point out is, again, this sort of comes out of the media. When the media sets up the dramatic story, they like to have the good guys and the bad guys, and sort of the villains du jour right now are the big financial institutions, especially in the U.S. and in Europe. Again, not so much Canada. Good for you. So when they talk about the villains, like I said, the big villains right now are the large financial institutions, the CEOs that got big paychecks, all that kind of stuff. Okay? Now, the thing is, there's no doubt that a lot of the financial institutions worldwide have made some really stupid decisions. Okay? I'm not going to defend their decisions. They're in retrospect, they were stupid, and they probably should have been seen to be stupid even before the fact. Okay? But the fact of the matter is, when it comes down to it, it's not against the law to be stupid. Okay? And I dare say it's not even unethical to be stupid. Sometimes people are just stupid. And it's not against the law to be a smart person that makes a dumb mistake. It's not against the law to take on risk that doesn't end up working out the way you thought it was going to work out. Those things aren't against the law, and they're not unethical. But the government's role, the government via the regulatory system, for financial institutions, is to make sure that they set up the rules of the game so that when somebody does something stupid, not if, but when, because people will always do stupid things, when somebody does something stupid, they're not able to jeopardize the entire financial system, okay, which is essentially what happened. So there's been a failure of regulation in that certain financial institutions, especially in the U.S. and in Europe, have been allowed to make huge bets, tens of billions of dollars bet on certain things that ended up being stupid decisions. And those bets were allowed to compound for years and years and years until they were so big that when they all went south, it sort of jeopardized the whole financial system. And there was a certain time, I don't think so much anymore, but last year when there was a certain danger that the entire financial system globally would just kind of crash to a halt. I think we're past that part right now, but we're still in a lot of danger. And in large part, to me, it's a failure of government to fulfill that responsibility. Anyways, that's all I wanted to say for now. Pass on the David.
Thanks, Greg. And I would also like to thank CCEPA for inviting me here to be with you tonight. As Greg and Greg were giving their comments, I was reflecting on some of the things that I've talked to clients about because my exposure in the investment business runs a span of about 25 years in a pretty broad mix of functions within that business. I would just want to point out one thing. Up here it says I'm with TD Bank. I am not with TD Bank. I was up until a couple of days ago when we parted ways, but I just wanted to make that clear. I'm not speaking on behalf of the bank. I'm speaking to shed my experience in the investment business. And one of the questions that I've been asked a lot while this credit crunch has been on is what happened and why didn't people see it coming? And what do we do next? In the easiest way to explain things, these two have done an excellent job explaining their views. When you're dealing with retail clients, you have to explain things in very few words because people don't have the attention span to listen to long-winded explanations. And so what I came up with when I thought this through, I thought, okay, well, the capital markets are in trouble and there's no liquidity. The way to communicate it is that liquidity is like oxygen to capital markets. Without that oxygen, the capital markets dry up. And you've seen what has happened, and you've heard the two Gregs explain it in much more detail than I could provide. But that's a simple way to understand it. Now, one of the other factors that is huge is that when you look at businesses, and it doesn't really matter what industry the business is in, if the senior management of the business runs into a problem they don't have a solution for, their reaction is always the same. They throw money at it. They throw huge sums of money at it. And they tell subordinates to get it fixed. We saw that with the Y2K problem, with the tech bubble. We've seen it with many other areas of investment and business actions over many, many years. And what struck me with the role of the government in this is that they were behaving exactly the same thing as the CEOs. They were going, okay, what do we do? We've never faced something like this before, so let's throw money at it. What's the number? Well, the first number turned out to be, what, 350 billion, and then it went to 750 billion, then 850 billion. Where does it stop? But the clear message out of that was that even the government didn't know what to do. And they were trying to come up with something. And they thought that putting money in to prime the pump, to do all these things that they'd been told by the economists and advisors would work to try to get out of the mess. Now they end up owning 20% of the banks in the United States. That's never been a situation that's happened there before. But I wanted to also deal with the question of why didn't people see this coming? And I think a good way to address that is, has anybody here in the room heard of Mercer's, the advisory or portfolio or pension manager assessor? Okay, well, Mercer's tracks, for those of you who haven't heard of them, Mercer's tracks investment managers all over the world. And they rate them. They rank them. They poll everything that they do. They monitor everything that they do. Well, each year they embark on an exercise that's a little bit of fun. They challenge them to predict the future. And not too long ago, they released their study for 2009, but it's even more interesting to go back to the expectations for 2008. Because there were 54 managers that commented on this, and I think the correct number is they oversee more than $6 trillion worldwide, which is an awful lot of money, obviously. And not one of them had gotten the call right for what the economy was going to do in 2008. And these are people, very smart people, who spend all their waking hours and probably some of their sleeping hours considering what's going to happen in the markets. Okay? So those three questions were the three that I get asked the most. How did this happen? What did the governments do about it? Why didn't we see this coming? And then another question is, what do we do about it now? And since we're dealing with an organization that's focused mainly on ethics, I thought, okay, well, in the investment business, in the investment industry, there's many, many examples of ethical violations. And I would like to say that I believe that those are the outliers. It's not normal behavior. But nevertheless, it involves money, generally a lot of money. It gets a lot of attention, and people often go to jail for violations of it. But I thought one of the ways to approach the ethical side of it is to there's a quote that I really like that I want to share with you. And the quote is, "Philosophy has taught me to do by choice what others are compelled to do by laws." And I thought that really reflects a lot of what ethics is about, because the operative word there, I think, is choice. And I think that ethics is how you choose to conduct yourself in the absence of rules. Now, that being said, we live in a capitalist society. We live in a society that's mostly look out for yourself. And we also live in a society where there can be huge rewards for doing certain activities. Which begs the question, do ethics get influenced by money? Oh, there seem to be some cynics in the audience. And I was reminded of that old joke about the one where the man is in the bar talking to the attractive woman sitting next to him, and he asks her if she would sleep with him for $1 million. And she smiles, and she said, "Well, I'd consider it." And then he said, "Well, would you sleep with me for $100? And she says, "I certainly would do no such thing. What kind of a woman do you take me for?" And he said, "Well, madam, we've already established your character. We're simply arguing over the price." And I thought, well, is ethics something that is truly subjective and can be affected by the price? And I think that's one of the major issues in the investment world. There can be so much money on the table that people compromise their own values because of greed. I mean, anybody could be presented with a situation where if somebody says, stop me when there's enough on the table, and they just lay out hundreds or thousands of dollars or millions, where they might be tempted to do something against what they would previously have thought of as their values. So when I think of that, I think, okay, there's obviously self-interest there, and is the self-interest rife with potential conflicts of interest? Now, in my area of business, I advise people about what to do with their money, about what to do with their finances. And it's obviously a business relationship. I get paid for that. I get paid for providing the advice. And I do it because the people who come to me have neither the time nor the aptitude nor the inclination to do it themselves. So there is a huge ethical scenario there, because I, as the informed investment person, am dealing with somebody who admittedly comes to me because they don't have the knowledge. So what does that do in terms of the way in which I deal with them? Well, I think that comes to a very personal approach about dealing with money, dealing with people's beliefs, dealing with people's expectations. And interestingly enough, there is, the term when you're in any position of trust is obviously a fiduciary, but in the investment business, generally, the relationship as a fiduciary is only implied. It's not regulated. And I think that's very significant, because we were talking about regulation earlier at dinner, and how you can possibly regulate hundreds or thousands or millions of transactions when they're generally one-on-one. There is no tape recording. There is no big brother watching you. How do you regulate those? And in fact, there's no other way other than to be ethical about it. Yet we find that people can be challenged all the time in the investment world about ethics, and again, it's because of the money. So I didn't want to go on a big, long diatribe, but I want to say that when I was trying to simplify things in terms of ethical behavior, I thought, okay, well, let's come up with 3 really simple things to judge ethical behavior. In the investment business, I always think, okay, how does it feel to me? How does it feel in my gut? Does it feel like it's the right thing to do? Excellent question. And I also think, okay, how would you act if your mother was looking over your shoulder? Also, pretty good question. The third question is, how would this look on the front page of the Globe and Mail? And if you can answer those 3 questions with a clear conscience, then there's a pretty high probability of ethical behavior in the investment business. Those are all the remarks I wanted to make. Now I'll pass it back to Bill, and he can open it up for questions.
Thank you, all 3 of you. And I think you've really opened the thing up for discussion. And Greg is right that the Canadian banks are the best of a sorry lot, which means that you're less bad than the others. And have done pretty well, but it's an awful picture you have worldwide. And I guess I have a couple of questions I want to throw out here, just to press things a little bit. And I'm reminded of an experience I had when I was president of Maritime. We did a lot of M&A work, so you spend a lot of time with investment bankers who are very smart, good people most of the time, but they have a certain point of view. And one day I was talking to one of them about a particular deal, and I wasn't sure whether he was working for me or working for the other side. I said to him, "Who's your client?" And in an unguarded moment of utter honesty and transparency, he said, "My client is the transaction." Now, I want you to think about that. It was a very honest and accurate answer. My client is the transaction. In other words, what matters in terms of me getting $1 in my pocket is that a transaction happens between you and the other guy. Whether it's good for you, that's your problem. Whether it's good for him, that's his problem. What's good for me is that there be a transaction. And much of our financial world is based on that premise. Now, what I want to throw, David, I'm going to ask you first, but then maybe Greg or Greg, you want to get in. Is that okay, or is that a fundamentally flawed setup?
In my opinion, it's a fundamentally flawed setup. It's accurate, but it's flawed. When I was working in a research department in Toronto, I had a similar sort of discussion, but our corporate finance people always seemed to recognize it was the institution, it was the company that needed the money that was their client. And I would argue with them that there are clients on both sides of the table. And I think that's been one of the fundamental flaws of the investment world over the past couple of decades, because I think there is almost an ignorance of the client who's on the other side of the table. It used to be with all these corporate finance deals that the purpose of raising money was to buy a new piece of equipment or to build a new factory or something like that, something productive. Now, as often as not, it seems when you read a prospectus, well, that's, for the last 12 months when they stopped issuing prospectuses, because deals stopped. When you would read a prospectus, you would actually find from time to time that the purpose of raising the money was to facilitate estate planning for the owner, which really means they're trying to take the money out of the business, or to buy out shares held by the major principals or by a company that had put money in earlier, and they use this as an exit strategy. But the idea of there not being clients on both sides of the table is fundamentally flawed. I do think that the description that he gave you about the transaction being the client is really, really interesting and honest. But I don't think it's an appropriate way to view the situation.
Maybe I'll just play devil's advocate here, just because I like to cause controversy. So going back to Bill's example, where the client is the transaction, to me that's the appropriate thing. Because if I'm the investment banker, I mean the problem with a lot of financial transactions, as David just pointed out, is there's always a buyer and a seller. Somebody's buying something from somebody else. And if I'm the investment banker, in Bill's case here, then I've got somebody buying and I've got somebody selling. Now I want to make $1 because everybody kind of wants to make $1 at the end of the day. The way I make $1 is by having that transaction go through. Right? If I can make that transaction go through, as long as there's transparency on the system, and everybody knows what's going on and how the rules are working and how the deal's being set up, as long as you have transparency, then the only way that transaction is going to go through is if Bill's happy on the one side of the transaction and then the person on the other side is happy as well. Right? So if I can make both those people happy, then I can get the transaction to actually take place, and then I can make my $1 and go home and be very, very happy. So if I can get that transaction to go through, then presumably I win because I made money, and Bill thinks he won, and the other person thinks he won too. So it's happy, happy, happy. We're just all living in a great kind of land. Now in the end, presumably someone's going to lose and someone's going to win, but going into it, everybody thought they got a good deal. And I think that's all you can ask of some transaction. I mean, there's always going to be a winner and a loser, but all you can ask of any kind of efficient transaction is that everybody's happy with the way things are set up initially anyways. So I think it can work that way.
You want in on this one?
Yeah, I don't have much more to add, but I tend to agree with Greg in this particular case. I think there's parts of the financial services industry that are more transaction oriented in terms of their very nature. And in the investment banking business, let's face it, you do transactions and that's how you get paid. There's no annuity. The clock starts again at the new fiscal year, and you go out and you work transactions, and presumably you add value. And I think at the end of the day, that's what any client should stand back and reflect on, to say, was there value added by the investment banker in terms of what do they brought to the transaction? But at the end of the day, that's how they get paid. So I would probably slant towards you, Greg, on that one. But at the end of the day, I think there still has to be a value proposition. At the end if there isn't one, then I think ultimately that the firm that investment banker works for will lose some business.
I was hoping that somebody would take that point of view. I have a second question. Asset-backed commercial paper. Everybody's familiar with asset-backed commercial paper? No. A year ago, asset-backed commercial paper was a $110 billion business in Canada. And it was roughly what you would get from the words. You'd have a pool of assets that would be wrapped up in an instrument and then chopped up and sold to investors, some retail and some corporate. Most of it was sold to corporate, but some retail investors were buying it too. And this was supposed, it was really great. People like David would phone up their client and say, look, you got some money, you want to invest it in some short term, but why buy Government of Canada? I can get you an extra 0.25% by putting it in this asset-backed commercial paper, and it's just as good, credit, and it's only a short term anyway. David, have I got that about right?
Just go with the story.
Yeah, just go with the story. So then it just turned out that the instrument didn't work. And even if the stuff backing the assets was good, there was some problems because there were some guys in Europe who didn't agree with the way the wording was interpreted in Canada, like Deutsche Bank and all these guys, right? They said, well, we don't think so. 999. So all of a sudden, people couldn't get their money back when they thought. And you had some businesses, Transat Airlines would be one example, lots of others, were in very serious difficulty, not actually because they had lost the assets, but they couldn't get a hold of the money when they needed to pay their fuel bills or whatever. And it seems to me that the people who acted where the transaction was the client, somehow it didn't work out too well from the point of view of the retail and commercial customer. So I'm just going to throw that out, and you guys can deal what you want with it.
Maybe I'll start with that. I think the issue with that is around transparency. And, to what extent did the investment advisors that were participating with asset-backed commercial paper, to what extent did they sell the notion of these investments to their retail investors in particular, saying that they were essentially as good as cash or as good as money market instruments? To what extent did they provide full disclosure around the types of assets that underpin these investments, and how well was that understood? And I think what you would see in the media would suggest that there's a lot of retail investors out there that actually didn't understand that, and there probably wasn't full disclosure. And there's remedies, I think, for retail investors that, in terms of them purchasing investments like this, and when they don't have the kind of sophistication and knowledge around what they're getting into, and those remedies would provide more protection for those retail investors than they would, say, to a company who would have, professional management and a CFO, or somebody who ought to or should have known around the types of investments that they're getting in. So I think the question is one of transparency. How clear were they, and did they give them the full goods or the full meal deal in terms of what would happen in the event that there was an underlying problem with the assets that in the vehicles, or what turned out to be a liquidity issue that caused these investments to be not to be able to be traded in the market. So I think it's a transparency issue. I'd also go back to what David said earlier. I would say that I don't think this is widespread. I think this is more of an outlier, and in particular one or two firms. But
I think one of the along the lines of transparency, I think that there has to be the assumption in a capitalist market is that there are informed parties on both sides. And if you think about these deals that have been struck, you can imagine 8 corporate finance guys working for 30 days to put a deal together, and they know every in and out of it. They send the documents down to what I'll call the retail force, and the retail people are supposed to explain 30 days of work by 8 guys to a client over the telephone in about 4 minutes. What are the odds that retail client is going to be fully informed? Frankly, what are the odds the advisor is going to be fully informed? So I think with a lot of these things, if it seems too complex, stay away from it. If you feel you don't understand it, don't go near it. Because there's too much in the way of complicating language, which is thrown out there at people who would be investors or potential buyers of these things, and it is not reasonable to expect them to be informed or fully informed, let alone fully informed, enough to make a smart decision.
I just say I agree with both those points of view. I just want to reiterate a couple of things, which is the transparency aspect, which I think is definitely key to this. People didn't necessarily understand what was going on in there, and it wasn't necessarily explained to them that well. The other thing I want to mention is that, again, as David mentioned, I'm not entirely convinced that a lot of investment advisors are able to explain to investors what exactly was going on in this asset-backed commercial papers. I'm not sure they necessarily understood it themselves in some cases. And the reason I want to mention that again is because I think there was a too heavy reliance on outside parties, and in particular the credit rating agencies in this case. And I think it was only Dominion Bond Rating Service that would rate the Canadian asset-backed commercial paper. I think they got AAA ratings. So basically you had this outside party that said it's safe. Okay? And the danger in that is that if you just take, well, if Dominion Bond Rating Service says it's safe, then it's definitely safe. I don't understand it, but they said it's safe, so fine. And you just go with that, you're running a big risk. Okay? And which is exactly what David's getting at here. And I think this is the best advice any financial advisor can give to anybody. If you don't understand what it is that you're getting into, then don't get into it in the first place. Even if it sounds good, if you don't really quite get how it's supposed to work, then it's probably not the kind of place you should be. So I wanted to reiterate those points.
I'm not sure if they meant to, but what David and Greg just said to you is that nobody should buy a hedge fund. Because they do not pass either of your tests.
No, they don't.
Right? They're opaque, and they're very, very difficult to understand. But I want to come back to credit rating agencies. Are any of you ever know what a credit rating agency is? How it works? Anybody confused about this? I'm confused about it. It's the most ridiculous business in the world. It would be like if you were making movies in Hollywood. The way the credit rating agencies work, if you were making movies in Hollywood, you would pay a movie rating agency to do a rating on your movie, and then people would rely on that to decide whether or not they'd go see it. Now, do you detect a conflict of interest? Right? This is the way credit rating agencies work. A borrower, somebody who wants to get money from an investor, pays a credit rating agency to rate their instrument. Okay, or in the case of this asset-backed commercial paper, which really isn't a borrower, it's one of those remote things that Greg alluded to earlier on, one of these slice and dice things. It's actually the guy who makes money on the transaction pays the credit rating agency to rate his instrument. Right? Guess what? He shops for credit rating agencies that give him the rating he wants. And then he turns around and says to people like Greg who have to do a 4-minute explanation of the instrument, it's okay, DBRS said I'm AAA. This thing's fine. It's the same as the Government of Canada. End of sales pitch, extra 25 bips. And I would say $110 billion is not just an outlier. That's enough money to notice, even in a day when everybody runs trillion-dollar deficits. 110. So what about the credit rating agency model? I mean, is it just hopeless? And if so, do you have a better idea?
Well, the credit rating agencies, it always reminds me of, this may sound strange, it always reminds me of going to the racetrack. Because when you go to the racetrack and you see the betting sheets and you see the odds on a horse, 6 to 1, 18 to 1, 22 to 1, you think, well, where do those odds come from? And how do they know them enough in advance to print them on that piece of paper? Well, the odds are made up. There are predictors of odds, individuals who will say, oh, well, this horse ran this, this, and this. Let's start it at 6 to 1. And then the actual odds are established by the number of bets placed on the horse. And you see those on the illuminated panels at the center of the track. Those odds change as more bets get upon them. But what that says is that the people who are the predictors of these odds are trying to make educated guesses, but that's the best that they are, as to how a horse is going to perform. And in a lot of ways, with the credit rating agencies, and especially what we've seen in the last 12 months or so, where, hey, balance sheets aren't supportable in terms of being accurate now. So the credit rating agencies are trying to make an educated best guess at the values of these businesses, but they've been basing them on financial statements that might be illusions. I mean, you see these huge write-downs on Bloomberg yesterday was the write-down for Royal Bank of Scotland. I mean, last year, this is actually a very interesting thing to take away as potential investors. Last year, if you looked through any international mutual fund, if you talked to any international money manager, everybody loved Royal Bank of Scotland. It was the best bank. It was the model bank. There was no other bank in the world that compared to it. And yesterday they announced a $41 billion write-down. That's big. And guess what? Now everybody's going, oh, Royal Bank of Scotland, it's a dog. Don't go near it. So the lesson to take away from that from an investment perspective is if everybody is saying something's great, if everybody is moving towards something, look the other way. Don't go there. Because it's very important to understand that when everybody gets enthusiastic about something, they will overvalue it. And when everybody is pessimistic about something, they will undervalue it. And where is it going to be a better deal for you? So that's an extension of the credit rating agencies. But
yeah, I'd like to pick up on this, and please don't construe this as supporting the credit agencies, because I don't have any specific interest in credit agencies. But you asked the question around is there conflict because who's paying the credit agencies? And I think that's a great question. But if the folks if the corporations are going to pay the credit agencies, who is? So I think at the end of the day, is there a role for credit agencies to play? And in the absence of whoever's underwriting these issues to pay the credit agency, if that's not appropriate or there's an embedded conflict in that, then who is going to pay? And so I think that's a question that we would need to think about and debate a little bit, because at the end of the day, do they play a role or not in the whole process? And I would say, in somewhat of defense of the credit agencies, what they've run into and what they will say in defense of what's happened in the asset-backed commercial paper or in the CDO market, they'll say what we really didn't understand or properly assess, because it's really never happened in this magnitude, is the whole issue of liquidity and what happens when there is no liquidity. What happens when fear grips the market so much that what was a normal market that traded every day all of a sudden doesn't get traded anymore? And how does that back into the fundamental analysis at the front end when they made the rating on these instruments? They never really imagined what would happen under that scenario and couldn't model that kind of scenario. So I guess in somewhat of defense of the credit agencies, this is unusual times. We've never seen this before. And it's easy in hindsight to say, you know what, those ratings were flawed because there was embedded conflict around who paid the bill. So I think I understand the issue, but I think you have to see it on both sides.
Greg, for what it's worth, you may be able to make that argument in Canada. I don't think you could make it in the States. The stuff was crap. All they had to do was look through it. It was crap.
In fact, Bill, I just want to add one thing, because from an advisory
scientific word.
From an advisory's perspective, the interesting thing, and the thing which strikes fear into the heart of advisors, is that if you were to say, well, we didn't know, or we didn't realize it could be like this, the regulators say, well, you ought to have known. You ought to have understood that before you provided that to your client. So when it comes down to these sorts of situations, the advisor is almost always in a no-win position. And I think that's the penalty which they hold over advisors to try to get them to be absolutely scrupulous and careful about what they're offering to clients.
Okay, I'm going to do two more questions, and then it's going to be your turn. So I hope you're getting warmed up here. I want to turn to a situation that is less murky, and that's to deal with cases of evident fraud. The all-star fraud of all time, as far as I know, is Bernie Madoff. I think he now has the world record of $50 billion. And as most people read stories about Bernie Madoff, you know what we're talking about. He invested other people's money, and he told them they were making 10% every year, except that they weren't, and eventually he had to confess, and most of the money they thought was there wasn't there. $50 billion, an extraordinary amount of money. It's a lot of the people who lost it could afford it, but a lot of them couldn't. And it wasn't just individuals, it was charities and institutions and so on. And he's not the only one. There's a bunch of mini Madoffs being reported on throughout the States at the moment. And we're not immune in Canada either. We had a situation with an organization called Portus, which was largely done through retail customers. Not quite as disastrous for the investors as the Madoff one, but certainly involved that. And so what I want to know is, for the regulators, for the advisors, are these things just inevitable? Is that part of what you need in a freewheeling capital system, or what happens?
I don't think I don't think that they're needed. I think that they are inevitable. We've seen. The one before this that got the most publicity was another Bernie. It was Bernie Kornfeld in the 60s, who operated fund of funds and then fled with all the money. And I think that what happens is people become more and more complacent with risk, and they start believing things that at other times would seem truly extraordinary and impossible to believe. And that I can't bring myself to call him Madoff because I think Madoff is such a better name. But Mr. Madoff, what did the absolutely remarkable. I cannot figure out how he could possibly have carried this off for 30 years. It just seems inconceivable to me. And yet, at the end, he is reported on by his two sons. And then we find out in the last few days he's got $173 million of checks he wanted to send out to friends and family in his desk. And you just think, this is just too incredible to believe. And how could somebody like this do this without many other people finding out? Of course, there's going to be books about this. I'm sure there'll be a movie about it. We have a pretty good hunch that the 3-person accounting firm that he used to audit this business knew about it. But it certainly didn't seem to go beyond a very small number of people. But is it inevitable? I think, yes, it's inevitable because of this complacency that people develop about risk over time. And is it desirable? In no way is it desirable in my books.
Let me just jump in for a second and point out a couple of issues that come up here that have sort of come up again and again through all the questions, which I think sort of says are important, which is it is inevitable. I agree with that. It's inevitable in a system that lacks transparency, where people can't really see what's going on behind the scenes. And the other thing that comes up again, and it's come up before, is the idea of the investors investing in things they don't understand. The thing that shocks me about the Madoff case is, well, $50 billion shocks me. That's a lot of money. It's more than I make in a week. And the other thing that shocks me is, from what I know about it, he doesn't seem to have set up any kind of overly complex system to fool people. He just basically said, give me your money. I made you 10% last year. And they said, oh, okay, here's another $1 billion. I mean, it was a pretty simple little scheme. He managed to spin into $50 billion all of a sudden. And that's because, a lot of people, a lot of smart people, sophisticated investors that presumably should know better, and also unsophisticated investors, just sort of wanted to believe. I don't understand what's going on back there. It's not transparent. He's not telling me, but that's okay. I don't want to know. It's something too complicated for me, but I'm going to put my money into it anyways. And it's amazing how many people were willing, smart people were willing to do that with no transparency and without really understanding what they're getting into. I mean, it was sort of an easy crime to pull off if people just believe whatever you say.
Okay, last one, and then, as I say, it'll be your turn. I want to go back to this word transparency, because it is a very important one, and I think it's pervasive here. It has to mean most of the things are available to look at, and that people take the time to look at them. Both of those things have to apply for transparency to be useful. Which brings me to the question of accountability. Thinking about some of the institutions that have got into various serious difficulties, such as the Royal Bank of Scotland and lots of other banks, and their auditors. Think about their boards of directors and thinks about their auditors. Now, if anybody has access to the information, they do. And they should have an interest in looking at it, since they're getting paid rather well to do so. So, like, what's your freewheeling comments on the auditors and the boards of these institutions?
Well, I think the glaring example to look at is Arthur Andersen with Enron a few years ago. When Enron collapsed, it not only took life savings of many people away, it also took down Arthur Andersen, which was one of the major accounting firms globally. And I think there can be a conflict Bill referred to the fees that are being paid. One of the big concerns was that the dollars that Enron was paying to Arthur Andersen were enough to get them perhaps to ignore certain things. I don't know if that's true or not, but certainly the audit fees were huge, and Arthur Andersen paid the price by disappearing. I think it opens the issue of not only the relationship of the auditors, but the boards and how boards are comprised and assembled, and the responsibility of boards to judge the management of the firms. And it certainly appears, as an outsider, to be badly done in a few instances. I think most boards are very responsible. Most boards are very aware of setting policy for companies and for guiding the management of companies. But I think in a few very sensational cases, it's all fallen down. The board, the management, the auditors, the regulators have all fallen down on the job.
And just to pick up on those points, I think that the job of a director and any board these days is getting incredibly complex because the products and the innovation or financial innovation, if you think of things like collateralized debt obligations and credit default swaps and just the very nature of these instruments are getting very difficult to understand, and when things are difficult to understand, transparency becomes a problem. And I think for any director, as we go forward, and really coming out of the Enron piece lately, is that there's been a lot more emphasis on board governance and around the role of the director, the independence of the director. And I think what is going to happen moving forward is that complexity is going to increase, and I think we're going to have to educate directors a lot more than we had in the past. So I think who you choose on your board and what skills and competencies they bring will become a very, very critical task going forward, so that you match up the competence of your boards to the complexity of your organization, so that they really have the ability to assess what kind of risk is in the organization and what's the nature of the type of complexity that's being built into these organizations, so that they can push back on management and make sure that they have the independence that allows them to manage the risk of the organization. But I feel for board members these days because it is a complex and it's a lot of risk and a relatively little reward, I would say, in some cases.
Yeah, I just want to touch briefly on the auditors, which I'm not going to defend the auditors, but, well, I guess I will, sure. I'll defend them. The auditor's role is limited in a sense in that they're going to go into a company or a financial institution and decide whether or not the books they're presented with follow generally accepted accounting principles. And I assume that in the case of Royal Bank of Scotland and Citigroup and all those other kind of major financial institutions that have declared losses, that they were following generally accepted accounting principles, so the auditors signed off. The question to me is whether or not the principles that are being applied are good enough. Maybe those accounting principles weren't really catching the real risks. A lot of banks had a lot of the losses of the major financial institutions were in things that had been held off balance sheets. They weren't recorded in the books. They weren't required to record them in the books. So that's not necessarily the auditor's fault, right? At least not as far as I know yet. But it could be the fault of principles of accounting that aren't really catching up with the financial innovations that are out there, because it is an increasingly complex area, and it's really hard to keep up on all the different securities that are involved.
And just one thing to add to that, it was the Enron Arthur Andersen instance that got the auditors to change their disclosure statement at the end of every statement and every audited sets of papers, because before they would say that the company is in good order according to their audit, and now they're saying, just as Greg has said, they comply with generally accepted accounting principles.
Okay. Thank you, gentlemen. Thank you for being so tolerant of my poking away at you. Who would like first at the mic? Pat.
Good evening. Patrick Moriarty, Halifax. Just carrying on from your last remarks, what prescriptions would you offer further to what you've already said so that in 5 years from now we won't be sitting down at a panel like this and describing another scenario of what we've already seen?
Over to you.
Yeah. That's a big one.
I have to give you my honest answer. I haven't really pre-thought that particular question, but my honest answer would be that 5 to 10 years from now, whatever the time frame you pick, we will be dealing with a different issue that we didn't even know existed today. We've gone through the Enron scandal. We've gone through Briex. We've gone through this financial meltdown. In every case, there's been some new event that has happened that has become painfully obvious in hindsight, but wasn't necessarily there in foresight, despite all of the amazingly smart people we have globally. So I honestly think that there will be a new set of circumstances to deal with, a new crisis that will take us in a whole different direction. And I guess what I would encourage all of us as we think about how do we respond to this is that we don't overdo regulation to the point that we are paralyzed. And I think that's a real risk that we run that could add incredible amounts of cost to all of our institutions, all of our businesses in North America and everywhere else, that could end up being unproductive. Because ultimately, if somebody is out there that wants to create a fraud, they'll find a new way to do it. And you can't regulate everything, and you can't regulate, I think as you said earlier, David, you cannot regulate around people just having good ethics. Mm-hmm. Because somebody will find a new twist on an old system to create a new crisis for us to deal with. So that's kind of my gut reaction.
Yeah, I can just add to that. I think it is very important that we don't, or we, meaning the regulators, don't rush into anything in a bid to quickly solve the problem and sort of throw regulations like this. They threw the Sarbanes-Oxley stuff at companies in the U.S. which hasn't worked out all that well. So this is the kind of issue we want to look at, not tomorrow, but over the next several years. How do we sort of make the system work a little bit better? We don't want to redo the system and make it work a little bit more efficiently, so this kind of thing doesn't happen again, hopefully. Now, exactly how that's going to work, I don't know. I mean, that's going to be sorted out over the course of a number of years. But I think two things that are going to have to be addressed are, one, transparency. So I think there's going to be a need for more transparency that'll have to be regulated, so that people can't sell some type of security where they just say, invest with me. I'm not going to tell you what I'm doing, but trust me. That's not going to be allowed anymore at some point. And the other thing is more limits on the risks that financial institutions can take on, banks and investment banks. Now, whether that's more stringent limits on risks or more stringent limits on how they record their risks, they're not allowed to record them off balance sheet or something like that. But there's going to have to be more limits put on those things. Now, exactly how they're going to do that, I think it's a good idea to take a good chunk of time to sort out the best way to do that, so you don't, throw the baby out with the proverbial bathwater.
I got to get in here because I had to live with Sarbanes-Oxley for a few years, and it's just, Patrick, that was the answer to your question after Enron and a few others, WorldCom and some others. An overreaction. Well, not only an overreaction, but utterly ineffective. Created tons of work for companies, tons of revenue for accounting firms, and didn't solve or prevent any of the issues we're dealing with right now. So. I'm sorry, David.
That's okay. I'd like to take a two-pronged approach to answering that. One is as a citizen, and one is as an investor. In terms of being a citizen, I think it's important for us to challenge our politicians to make sure that they're monitoring this sort of stuff. And I think it's along the lines, oddly enough, of what Obama was saying yesterday. For years, our societies in the West have had members of the society scream, "I want my rights, I have my rights." Nobody that I've heard has said, "I have my obligations as a citizen." So it's partly up to us as citizens to hold or to create the will on the part of the regulators to make these sorts of things happen. The flip side of that is, from an investor, the most important thing is to know what you're trying to do. Because really as an investor, what you're trying to do is you're trying to achieve a return that is the highest safe return you can get. Okay? Most people will choose securities because they heard about this thing at a cocktail party. Their neighbor's been getting 12% and they want 13%. All these sorts of dumb reasons for going forward with investments. What I'll suggest to you is that if you know what you're trying to achieve, then you can firstly worry about things within your control. You can design a policy which can help you create a personal benchmark for yourself, and you can have something to hold both your advisor and your own sense of discipline accountable over the years, so that 5 years from now you'll be able to look at what you were thinking, and you can say, okay, well, this is how I decided I was going to act if this happened or if something else happened. But the bottom line is to know what it is you're trying to achieve and accomplish before you pursue any road of investment.
Okay.
Hi, Bill. Al Chaddock is my name. 45 years ago, Bill and I used to sit around a library in a private school not far from here and discuss ethics and great books. Here we are again, Bill. Ethics, applied morality. Where do you get your morality from? Which church? Which group of laws? Pretty clouded issue. Then you have your in-house ethics, your professional ethics, your pecking orders. Then you have all of that overlain with the idea that you get economic and political advantage from withholding information from others so you can exploit it for your advantage. So knowledge is power. And information, well, we're all trying to figure out what information is because we're all drowning in it. And I know lots of people who are sitting out in the middle of nowhere on computers playing stock markets on the internet. And their only reason is because they're bored out of their mind and they like to win. And that's the only reason they're playing. We're talking millions of people. How many margin buyers brought down the market in 1929? Multiply by how many and see how many are doing that today. And we're trying to stay ahead of that with computer programming and monitoring. It's insane. Applied morality. Well, let's go another tack. Let's talk about the public good. Let's talk about the commonwealth. Let's talk about what John Ralston Saw is talking about in his latest book, A Fair Country, the common bowl from which we all eat and therefore have a vested interest in keeping clean and always full so we can all eat according to whatever our needs are. What about the idea of usury? That's in most religions. I mean, what the hell is that? Everyone kind of skates around that one. What do we mean by that? What do you mean? What do you mean we shouldn't take advantage of someone else's needs? Boy, that brings a lot of houses down fast. Ethics in financial markets. We've just seen a large imperial power promote what pretended to be an ideology called monetarism and market fundamentalism. That was being... I'm getting to my question. I'm getting there, Bill. We have just seen the commonwealth of the whole world trashed for what is summed up by one word, greed. Greed and absolute stupidity and the most gross selfishness any of us can imagine, and we're all part of. Now, we're all hoping this mutt of a man, he's not a black man, he calls himself a mutt, we're all mutts. He doesn't want to be a black president, he just wants to be a damn good one. He's talking about the same stuff. We've got to reinvent ourselves before we reinvent the world. But how can we have trust in institutions, all of whom have been found guilty by our highest courts of fraud? Our previous Martin and Chrétien were just found by our highest court to be guilty of breaking the first principle of democracy, no taxation without representation. My question to you is this. My question to you is this. What are each of you going to do in the light of what we're supposed to be talking about tonight? What are each of you personally going to do so that tomorrow morning you're not going to do things the way you did them yesterday, and you're going to try to be better at your job? I'll leave you with one quote from Roy Jodrey, one of the richest men I've ever known. This is the quote. If everyone involved in the business transaction doesn't profit from it, it's not good business. That's it. My father said the same thing. Talk to men who make wealth and women who make wealth and who work with others, and they'll all tell you that. Okay, talk to Jim Kinnear. He says that. So my question is, what would each of you like to do differently from now on so that you can be part of our collective reinventing ourselves?
Let me just answer first because my answer is short. Nothing. I'm going to do nothing different tomorrow than I did yesterday. That's it.
Actually, that's a great answer, Greg. Because if I say something else, it implies what I was doing yesterday wasn't good.
That's right now.
Ditto.
I'm not going to let you off the hook that easily, actually. Instead of yesterday versus today, let's talk about this year versus how you felt a year ago. You had more knowledge and information today than you had a year ago, and you have understandings of risks that you didn't have a year ago. We've all been surprised by the way things develop. In the context of what has surprised you in the last several months, what would you be doing differently at the beginning of 2009 than you were doing at the beginning of 2008?
Okay, that's that. Yeah. Thank you for that clarification. I'll give you a personal example. In 2008, I made some investments that I thought were pretty good investments, and I thought it was a fairly well diversified portfolio. I'm talking about me personally, and I probably made some of the same mistakes that a lot of other retail investors would make. Is I invested in names based on my view of what those names were, but I really didn't do as much due diligence on those individual investments that I should have. And I did it because it was, read the paper, I listened to BNN, I looked at the analyst reports, but I didn't fundamentally look at those individual companies to the point that I should have, and guess what? I suffered. And I think in this world of complexity, in this ever-changing world, me personally, I have to protect my family and my own investments. I'm going to be much more due diligent in making sure that those investments are sound and secure, and at least I understand what I'm getting into. To your point, where is it taking me? What's the destination? And in business, I think there's also an opportunity to make sure that the same kind of due diligence goes into every decision, and that you take the time to reflect and to make sure it's consistent with your strategy. And I think those lessons, I think for all of us, are going to be important, because the issue of transparency, I believe, won't go away overnight.
I mean, if I want to look at this in terms of last year versus next year, from an investment perspective, my answer is nothing again, because I got a long-term investment horizon, so I'm not going to panic. I mean, it's no fun looking at my pension statement, but I'm not going to panic about it. Stay the course. Keep telling myself that. But going back to sort of the ethical dimension of it, I guess. Again, my answer is nothing, because there's no doubt that greed in large part has gotten us into the mess we're in now. But I would also argue, I'm doing my Gordon Gekko from Wall Street imitation here. Greed has been the cause of a lot of bad things the last 18 months, but over the course of the last 200 years, people acting greedily have led to some pretty good advances. And we stumbled a couple steps, and things aren't going quite as according to plan the last year or so. But I think greed and Adam Smith's invisible hand have taken us a long way as a society in the long term anyways.
In terms of doing something different, what's happened over the last year professionally to me, it's reinforced what I was doing with clients, because it worked better. I'm not saying my clients didn't suffer a loss in 2008, But I know, I was talking to a fellow yesterday, and he said, I finally got around to opening up my year-end statements. And he said, I've done a lot better than I thought I would. And he said, I've also done a lot better than my friends. And I thought, because I thought when he said, I just opened my year-end statement, I thought I was going to get a strip torn off me. And the point is that with him, as I do with all my clients, I do embark on that process of deciding what people are trying to achieve. And I find that the great value of that is it tempers their enthusiasm. And it doesn't let them become too pessimistic about things. And if they are able to understand better what the process is, they're less likely to get scared or less likely to become over-enthusiastic about things. So what would I do? I just make sure that I'm adhering to that process that I feel is already in place for my clients.
Okay. Doug?
I'm Doug Hall. Just for those of you who don't know me, I'm a retired investment banker. I'm one of those guys right in the middle of the trades. I thought we should go back to ethics. And the question I have is, for each of you, what balance you put between greed. I'm sorry I was going to do the gecko thing. Thanks very much, Greg. Greed and altruism. For example, everybody is greedy. It's part of human nature to be greedy. And when that Wall Street movie, if you haven't seen that movie, by the way, you must watch it. When he says greed is good and extols the virtues, obviously he went over the edge, but I think the point is greed is not bad. It's not good, but it's not bad. It's what drives a capitalist society, and I think the role of a community, of the society itself, is to have enough rules and restrictions and guidelines to ensure that personal self-interest, another word for greed, lesser word for greed, personal self-interest doesn't get in the way of social goods. So you can't lie to people and you can't do a lot of things. You can't do this, can't do that. But it's to constrain the innate desire of people to get ahead, to make a profit. There are societies in this world who say that profit is bad. They're not bad, but they have to be controlled and contained. So the question is, you have a client that walks in the door, and I guess you two have clients, but you, Greg, will have to pretend. Have clients that walk in the door, and on the one hand, you know that it's valuable to your institution or to you personally, doesn't matter, to do this transaction, to sell something, to accede to some view that they have about the world. And on the other hand, you're not so sure that's the right thing for those people to do, that you have a common interest in what they think or what's best for them, and you can't hide behind what's best for them. Sorry, that. The other side of it is you really should do something differently in your heart of hearts because you wouldn't do that transaction. How do you do that? How do you balance that and say, I will not do this. I will not take your business because I don't think it's right, which is imposing your views on them. How do you do that? That's ethics.
I have, my way of dealing with it is, I have 5 kids. And when you're raising kids, they range in age from 4 to 18. And I always think everything that we do in life is an example for somebody else. And I think of that in terms of how I behave with my kids. I think of that in terms of how I behave in business. And I can't control somebody else's behavior who might choose to do a transaction that I don't think is good. All I can do is say, I'm not going to do it. So how do you balance that? I mean, obviously it comes down to ethics. It comes down to personal belief system, personal values, personal philosophy.
I think I agree. I think it comes down to personal ethics and what are your values and how do you apply those values in your work setting. The only thing I could say in the scenario that Doug put out is that if I was put in the context of the organization that I'm responsible for, it's just something that wouldn't be tolerated for a couple of reasons. It doesn't fit in our culture, it doesn't align to our values. So selling something to somebody that they ultimately don't need I think goes against the values of the organization. And if I were somebody in the organization that behaved that way on a consistent basis, I think I would be weeded out from a culture point of view. So it just absolutely wouldn't happen. And from an organizational point of view, as I said earlier, I think our overall philosophy is, what's good for the customer is ultimately good for the bank and vice versa. I think that model works over time when you're building a brand that's based on a trusted brand and based on a relationship strategy over a period of well over 100 years. By taking a short-term gain for self-interest in an environment like that will come back to hurt you against your brand. So as I said, from an organizational point of view, we would weed out those types of situations because it just doesn't fit the model. And when I say that, the model for me is Canadian banking. So that's our personal and our commercial banking, where I spent the bulk of my career.
Just before Greg MacKinnon gets in here, I want to twist the question a little bit, because a lot of the people that come through the program you're part of will end up working in banks and as advisors. I mean, it's a typical good training for them. So the question is, for you personally and for the university, what's your accountability for helping people to think about these questions and kind of prepare for them, confronting them in real life?
So you give me the tough question. Thanks. Well, I think there is a certain responsibility on myself as a representative of the university to discuss with the future investment advisors and bankers of the world, the kinds of responsibilities that they're going to have. Now, in terms of ethics, though, and people's outlook on ethics, I mean, it's hard to. I mean, you can talk about ethics, and you can discuss issues on ethics, and you can teach ethics, but I don't think you can necessarily, inject ethics into a student and say, here you go, here's your dose of ethics, off you go now. But we can certainly look at situations like the one you're describing that might arise and discuss, the various viewpoints. What would you do? Why is it important to think about those things? I'm not sure if that exactly answers your question, but I'm saying it's important to discuss those things, but I'm not sure, quite honestly, when it comes down to nuts and bolts, how we really do effectively have those discussions with students. Okay? The one thing I would add to it, though, is what Greg was just talking about is the way you reconcile the greed and ethics part of the thing. Okay? Because if the bank has its reputational capital at stake, which says if our advisors give bad advice all the time, then we're not going to be in business forever. It's that wanting to be in business and make returns for your shareholders. It's that greed part of the equation that sort of feeds into making responsible decisions for the clients. So I think greed and facing up to client responsibility sort of go hand in hand. If I wasn't greedy, I wouldn't do it.
Hi, my name is Steve Foran. Thanks for coming tonight. I want to share with you kind of what I've heard. And if I was to leave right now, what I would sort of be thinking what you said. Fortunately, there was some discussion on greed, although it came up late. I was a little surprised. And second is, we're okay here in Canada. We're okay in Canada. It's the other people that are greedy. But at the same time, I hear recognition that this is inevitable. Something's going to happen again. It's just part of doing business. That's what I've heard tonight. Am I right?
Yeah, I got the question.
Go ahead, Greg.
Thanks. I mean, I think that's probably a fair sum up of what's been talked about. In terms of the inevitability thing, I mean, it is inevitable that something like this will happen again. Not exactly the same scenario, but I mean, the financial markets and the economy go through a cycle of crisis after crisis. Sometimes there's 10 years between the crisis, and sometimes there's 20, and sometimes there's 5, and sometimes there's 30. And the fact of the matter is, each crisis is different than the last one. Okay, so we had Enron a little while ago on corporate governance, and now it's financial institutions and the credit crunch. And I'm sure, whether it's 6 years or 10 years or 7 years or whatever, there's going to be another crisis of some type. The problem right now is there's no way to tell exactly what that crisis is going to be. Okay, so it is part of the system is that it's inevitable. And I think I would go back to, if you think way back in history, like 18 months ago, central bankers, before the credit crunch hit, I mean, central bankers and governments were talking about how we had tamed the business cycle. And we were so smart now, it was just good times are going to roll forever and ever and ever. We'd figured it all out. And that's just not true. Okay, the business cycle's been going on for the last 4,000 years, and sometimes it takes longer to hit the next downturn, but it always comes eventually. It's a matter of setting up the system so that when the next downturn or the next crisis hits unexpectedly, because they're always unexpected, until after the fact, you set up the system so that when the next crisis hits, the whole thing doesn't blow up. That's the kind of thing I want to emphasize. The regulatory agencies and the government have to set up the system so that the whole thing can't blow up if one thing goes wrong.
That's a good point. The summary, as I listened to it, it was kind of depressing, but I think it's relatively accurate, and I think it's kind of an honest view of the way things are, and I think the opportunity for all of us as individuals or for whatever corporations we may be involved in is how are you going to define yourself in terms of what is it that you stand for? What are your personal values or what are your corporate values? And how do those values guide the decisions that you make transactionally or strategically? And over time, how will that translate into the longevity of your organization? And I think those organizations that have clarity around what their goals are, what their values are, and their mission, I think they will stand the test of time. And we have a lot of great institutions in Canada that have been around for generations and probably will be for generations. And we've had some very well-known organizations that have had their glory days and have fallen aside. And there's been some examples in the news recently. But I think for the hope in the message is that I think the greater good will prevail, and the more evil side of things may get a short-term gain, but they won't be there for the long term. And I think that's the hope in the message that's there, and I think that's a reality of how do you coexist in an environment where there are going to be some challenges and there are going to be some people that don't behave properly. But I think it's more a function of what you do and what you can control, and try to manage the systemic risk that Greg talked about.
I think there's back to Greg MacKinnon's earlier comment about newspapers and what gets people to buy newspapers. It's essentially a sensational headline. And I think in the context of this discussion, we have to keep in mind that it is a small number of companies, a small number of industries that are getting all the press right now. There are lots of other industries, lots of other business owners, lots of other shareholders who have a very successful experience, well-run companies that do not encounter these horrific situations. I think that it's situations like this that force us to address our ethical beliefs, our values that we represent to ourselves and to society. And lastly, I'll suggest that history does not repeat itself. I know that may make any historian in the audience upset. But history does not repeat itself. The one thing that does repeat itself is human behavior. The reactions that people have to crisis are always the same. And I think that's something important to take away from this. When we have the next crisis, people will panic. When we have the next statement that says, hey, we've got this economic cycle licked, people will react the same way. They'll become overconfident. And I think if you can learn from this, you can say, okay, well, when I hear that sort of statement, I'm going to reject it because I understand the context from where it comes, and I understand how I want to value that, and I'll be able to base it on my own beliefs, my own philosophies, and have a better understanding of the situation.
I'm just going to throw something in, and then we'll take your question. But I think something that's a bit distinctive of what we've been through in the last 3 or 4 months. I don't know if everybody in this room appreciates how close the entire world banking system came to collapsing in November. It was really close. I don't think, if you look at individual situations, whether it's at Enron or .com busts or WorldCom or things like that, I don't think very bright people of good intention have yet invented a system to prevent those. And I'm not sure they ever will. I think you're always going to have those, will be part of the noise in the system. But it is extraordinarily important that, really central bankers and finance ministries around the world come up with a system that leaves the world much less vulnerable than it was in November of 2008. We were almost back to bartering. And it's very, very important. And that is doable. We should never be that close again.
Hi, my name is Kirk, and I'm a philosophy student here. We've spoken tonight a lot about the market failure itself, but we've touched on how it might be solved, but we haven't really proposed any solutions. Now, the first gentleman to speak outlined 4 conditions that led to this market failure, one of which was the government, Washington, pumping money into Freddie Mac and Fannie Mae. The second gentleman to speak mentioned 2 things that might have led to it. Unscrupulous media people and not enough regulation. And the third gentleman who spoke mentioned, mentioned how Wall Street was pretty much throwing money everywhere to solve this problem. Now, I'm wondering, is government, the prevailing winds of, I think, business and the academia today are just, when we have a problem like this, just regulation. Like, we almost rely on the government to solve these problems, but don't we have plenty of scientific models suggesting that the markets, when left to their own devices, will obtain more properly than if the government interferes? And don't we have tons of historical examples suggesting the same thing? And furthermore, we're talking about regulations and getting the government to do it, but we have to ask ourselves, do we trust the government to do it properly? This gentleman over here tonight spoke of how we perhaps ought not trust all of our members of parliament and our prime ministers and things, because our hands are always dirty. And when the public is voting on such a superficial criteria like how someone walks or speaks or the color of his skin or things like that, that when no one really knows what policies someone might be presenting, for instance, can anyone tell me any of Obama's policies? He mentioned he might want to close Guantanamo Bay, but how and what are you going to do with these people? And give me some particulars of your policies. Like, no one knows these things, but so we're caught up in voting for people based upon superficial criteria, and we're entrusting these people at the same time with solving problems that science has demonstrated might be better left. Like the free market might find its own equilibrium, like the Italian economist Pareto said. So, what do you guys say to that? Thanks.
Let me just start off. And before I say anything, I just want to point out that I'm willing to bet I am probably the most free markets capitalist-oriented person in the room right now. Right? No, I'm number 1, buddy. I am a total believer in laissez-faire economics, but free market capitalist system works as long as the rules are laid out. Okay? So, for instance, everybody's allowed to be greedy, and Adam Smith's invisible hand says everybody acts in their own interest. Eventually you get an answer, a solution to the economy that's kind of the best for everybody. Well, that assumes that, for instance, somebody isn't just ripping somebody else off, telling them lies and that sort of thing. So the role of the government and regulation, and I don't want the government to start throwing on all kinds of regulations haphazardly. That's why I say this should be something they have to sit down and think about this for a long time. Okay? I don't want more regulation tomorrow. I want it 5 years from now, after 5 years of thought. They have to place regulations that keep the playing field fair and well laid out, everybody understands it, and then let the free market do its thing. And I think that will end up with the best long-term solution.
And just to pick up on that, I think the point that you're saying about the playing field is fair, but I think the issue is one of transparency. Yeah. And so if everybody has the same information or has access to the same information and there's more clarity, then I would agree. Let the free markets go. And I think what we've seen in this financial crisis is that lack of transparency allowed otherwise smart people to get into things that they probably shouldn't have had they understood the risk. And that contagion, I think, has created the systemic risk. So I think if we're going to do regulation or have regulation, if as long as it improves clarity and transparency, then it's probably a good regulation.
Your free market just had the largest government bailout in all of history. Where the hell is the free market? Transparency, where's the personal responsibility?
Well, that's not the free market, though.
Kathy, we're going to give you one last question.
Okay, I'm just going to follow on this theme. Kathy Driscoll, I teach business ethics here in the Sobey School of Business. And I just want to, again, picking up on just a few of the comments that were just made, there's a fundamental difference between Adam Smith's community-based economic system in 1776, where the impact of every decision that you made, you knew who you were affecting, who you were, and the regulatory system was in place because you did something and it was your uncle or your cousin or someone, it would come back to you. It was in a closed, small-knit community. We're talking about a global financial economic system where the decisions that are made, whether the buying decisions, the investing decisions, people do not know the impact that they're making on other people. So when Adam Smith was talking about self-interest being for the good of the collective, it might have worked. It might have been circular. But Adam Smith was not talking about greed being good. To the contrary, he talked about economic man and ethical man having to coexist. So I'm a little bit confused, and I want to go back because I think people need to re-watch Wall Street, because the message of Wall Street was actually that greed is what will ruin things. So I want to ask for a final question to the panel members before I walk out of this room. Do you believe that greed is good?
Answering whether it's good or bad is certainly a very black and white distinction. I think that it is good as a motivator to get people to act. I think that, like with most things in life, there has to be some sense of balance. This is not just with free markets or with just regulators. There has to be a balance. There has to be almost like the yin and yang of the markets. Because without that balance, one will go out of control, whether it's too much regulation or too much greed. And I think that for those who have seen Wall Street, Bud found out at the end that his actions would have hurt people, and he realized that there was an ethical aspect to capitalism beyond what Gordon Gekko had suggested. So good or bad, I think that's too much of a black and white. I think that the world is much more gray than black and white. So it's a little bit of each, I guess.
Well, just to carry on with and I apologize to those of you who haven't seen Wall Street, but go out and rent it tonight. In that movie, the Gordon Gekko character gets up and makes a speech about greed is good and greed is great, and yada yada yada. The end theme of that movie was that greed is not good. There's no doubt about that. But keep in mind that the person that wrote and directed that movie was Oliver Stone, and he has a certain left-wing agenda potentially. So he was trying to present that picture by presenting this greed is good thing in sort of an over-the-top manner. But I think, quite honestly, whether greed is good or not, it is the motivator of the vast majority of people in the world. And so that is what motivates people, and because of the system we use, free markets capitalist system, that's the best kind of system to take advantage of that motivator. So whether it's good or not, so I'll sort of reserve judgment. But it is people's motivator for the most parts, and the best system to take advantage of that is the kind of system we're using now, in the long run, as long as the rules are laid out by the regulators, and there's enough transparency.
I think profit is a good thing. I think organizations that are in for profit should be making a profit. I think if greed means that one party wins and the other loses, I don't agree with greed, and I think that's wrong. But I think profit as a motivator is a good motivator, and I think that can be achieved where all parties in a transaction get value and win. And where that doesn't happen, I think that's what we got to push against.
Thank you. I don't know whether you've thought about the fact that if we had done exactly the same seminar a year ago, I think we would have done it to a largely empty room because everything was lovely. We had a really good turnout today. Gentlemen, you've been great. You've been very patient and lots of prodding and poking, both from me and from the floor. And I think you've made a great effort at giving honest and open answers to the questions. So thank you very much. CCEPA is not a rich organization, but we have very modest tokens of our appreciation here. So don't leave you, they're breakable. So launch them down there if you would. But don't open them because you'll embarrass us by our penury. But the thought is what counts, and we really appreciate what you've done. It's great, and thank you very much. Thank you.
As we draw our evening to a close, I do want to thank Bill for being our moderator and interjecting his own thoughts to keep things lively as we moved along. I want to echo Bill's thanks to our panelists. These are all busy people, and we appreciate them taking the time. We always appreciate this wonderful facility here at St. Mary's University and want to thank them for making it available. And most importantly, to thank you for coming, for being so attentive, for asking thought-provoking questions. I remind you, you have an evaluation in front of you. We would really like to have your feedback so that we can consider it as we plan our next event. And our next event is a series that will be Trust in Education. We were going to start this last December, but circumstances got in the way. But at the same room, the same time, on February 10th, we will start that series when Dr. Paul Capon, the President of the Canadian Council on Learning, will be here to speak on, is our education system doing what it's supposed to do? And that will be followed on March 11th and April 16th by 2 other speakers. So I invite you to put those dates in your calendar and to join us on February 10th for the opening session of our Trust in Education series. So if you'd like to be on our mailing list, there's a sign-up sheet at the back of the room, along with business cards from CCEPA's 2 staff, myself and our General Manager, Chris Stover. So thank you again for coming. We really appreciate at CCEPA your involvement in the programming that we're pleased to bring to you. Thank you and good night.